Grow an actively managed portfolio of gold, silver, platinum, palladium, and rhodium with Auctus Metals today.
They gave these corporates license to essentially overspend and create a Ponzi, and then to do highly dubious accounting. I would say go so far as to say frauds, a circle of Enron WorldCom Mark 2.0.
Hello again, everyone, and welcome to another edition of the Auctus Edge, where we look to give the edge that precious metals investors are looking for. Francis Hunt, better known as the Market Sniper, joins us today. Francis is well known for his Hunt Volatility Funnel method, a systemized approach that answers the key question: what is the next best performing trade? Francis, welcome to the Auctus Edge. How are you doing?
Glad to be back with you, Patrick. How are you keeping?
I'm doing fine. Glad to get reacquainted with you. It's been a while. I want to first start off by asking you about a recent post you had made on your Twitter or your X account responding to David Sachs' post about AI-related investments being half of GDP and how we cannot go back. And you tweeted, "Recessions are a balancing mechanism for over-allocation of capital to less or productive activities. You don't banish feedback mechanism for a no-pain for all behaviors existence. That just builds a greater blowout later." Mr. Hunt, can you give us your insights to this?
Yes. So David Sachs, I'm not entirely sure what his official job title is. But he seems to have ended up as, let's just call it, some form of overarching czar of the AI development world. And, data centers, chips, this is not government business. This is not the provision of banking systems and the issuance of money, which has got this quasi-statist and private business positioning. The banking has that unique, and we've obviously found out to our cost the fact that they privatize profits and socialize losses and have been a massive burden on society, that banks have been following 2008 and various other things. It seems to me that this individual and his orchestrators, and can I say, I'd like to add into that mix, it's a very good question that you asked, by the way, Patrick, the CEO of NVIDIA, who on the recent earnings announcement said, we had the weight of the world on our shoulders. If we didn't deliver, a beat, the whole market and the world would have fallen apart. And there's an interesting theme in both that statement by the CEO of NVIDIA and David Sachs saying, and I just restate it again from your question in case people missed that detail, we can't afford to go backwards. AI-related investment accounts for half of GDP growth. Well, hang on. Who allowed that to be the situation in the first place? You get an economic concept of crowding out, where you starve other industries of capital and you put this big gilded blue-eyed boy child flag on the head of the surveillance grid that they seek to build out, that is a management tool and a compliance tool over our future freedoms in money and in biometrics and in everything else. They decided this was a very big priority. They gave these corporates license to essentially overspend and create a Ponzi, and then to do highly dubious accounting, I would say go so far as to say frauds, a circle of Enron WorldCom Mark 2.0, and at the same time say this fraud and this accelerated prioritization that governments and massive corporate fascist organizations that are trillion market caps have all been tipped to go do on the basis of, I would expect, dark state agenda, is now deemed to be in the too big to fail category. It's almost as if me and you, Patrick, started a hot dog stand and then decided there should be a hot dog vendor outside every single house and we had a couple of trillion of them around, and then told government the most important thing in the world was that people could have ready access to Viennas in a bun, and that to allow all these people to go unemployed would mean a 50% loss of employment in the entire world, and is a critical industry for that reason, and they should bail us out, given the fact that our hot dog profitability is deeply in the red. You can make a case for anything having a knock-on effect, especially if you first starve the rest of the world and hyper-prioritize something. You've engineered a one-legged stool for people to sit on. And now you say, hey, if that one leg goes, you're toppling to the ground. Well, recessions inherently are there. It's like cleaning out a septic wound for malinvestment, for the tidying up. You should take regular bouts of pain, stiffness if you've overworked out. It's part of locking your body down and getting greater rest to enable suitable recovery and establishment of mean and normalized performance. What happens if you've created a very skewed economy is that the feedback mechanism wishes to return the pendulum to the mean, and you saying, no, I'm going to keep pushing and holding the pendulum out to the far left here, because we actually have this corporatized Marxism stroke cacocracy that is desperate to build out a grid system that is going to strip everyone of their freedoms except for the ruling class. And there's nothing more important than all of us building our future slave mechanism. And they have the right to dilute currency and inflict inflation on us to make whole the malinvestment that has been excessively driven, that has seen a massive run-up in prices in this one core industry. So there's so much wrong with that. And the entire notion that we shouldn't. We need a full recession. We need a full collapse in the AI market. And they shouldn't get a single aspect of government bailout with it. They're all private corporations. They all multi-trillion market caps. And their CEOs are all centimillionaires, if not billionaires. And there's no reason why you should get bailouts. Funnily, on that point, before I hand back, it seems like the cursed classes are the middle classes. The very poor get welfare and the billionaires get bailouts. And unfortunately, you and I don't qualify for either, Patrick. And I fear that's the norm for 99.99% of the people watching us right now.
Yeah, some great points, Francis. I want to, I'll continue on with AI here because, the real world, we all understand, how AI is stressing the power grids, increasing people's monthly bills. There's talk of rolling blackouts or brownouts, as some people call them. So my question here is, how do we cope with this going forward, especially in a time of, say, recession or stagflation or high unemployment? Because that same AI that removed jobs may also raise the cost of living. And as David Sachs says, there's no going back.
Well, it's parasitic in every sense. It's the cuckoo in the nest. It eats all the food. It starves everything else and pushes the other babies out of the nest, leaving us inherently with what we consider to be, and I've referred to this many times, it's like the clown that does the balloon dog for your child, the twisted balloon. Only I say there's just one sausage balloon that's being twisted here, and one compartment is getting all the oxygen, call it liquidity and money, and everything else is being deflated away from the other half into that half until you end up with actually a broken and a spent rubber on one side and a hyperinflated rubber on the other. Unfortunately for us, most other industries are carrying the cost as usual. And I mentioned the phrase, the socialization of cost and losses on everybody else. And the privatization of extreme gains, all the data that goes with that, all the profiling, everything that the Bolshevik communists, the new technological Bolshevik communists that are going to impinge on our freedoms are busy uploading generally at a social level, are all being privatized, those profits, the share price, the options, the pay packets in that industry. And it's an absolute parasitic force, and it should never have been allowed to get preferential treatment and to get all the state contract awards that further are a transfer cost of money that could have gone into highways, airports, renewals, everything. In fact, America's infrastructure is not great at the moment. If you go fly into any of those New York airports, it's like going back into the 70s. Compare it to Singapore's airport, which I think you would be very familiar with, or, for example, Qatar or any of the others, and it's just tatty as all hell. But where's that money going? It's not improving the lifestyle and the access of infrastructure for citizens. It's going into trying to dominate this particular arena with these preferred entrepreneurs that all seem to have a very chosen profile. And it's a crowding out. This is the biggest case of economic crowding out as a case study that anyone has ever witnessed. And it's having collateralized damage to everything else. And I would say that a lot of those investments are reaching the point of, at this state, a point in time for revenues, entirely non-economic. And when you build a big boil on your shoulder, the way you heal is you lance it and you clean out the wound, and then you start the repair process. That's not being happened. They want to keep expanding it at the cost of the body that it exists on.
I'm not too familiar with this, so I'll throw it to you. About a week and a half ago, we saw reports where Michael Burry was shutting down his funds, let's say, and he was saying there seems to be a disconnect between this whole AI thing and where these companies, they have to keep buying equipment because there is this thing called Moore's Law, where about every 18 months or so, technology basically almost doubles at about the same cost. So when it comes to AI, all these equipments that these companies are buying, they're all going to be outdated very fast, very soon, and they're getting underwater with all this equipment. So I just want to know your take on this.
So the technology space is one where you have an incredibly short cutting edge life cycle. And then you fall to second tier, third tier, fourth tier very quickly. And what that does is it tapers money that was spent at a premium price at one point very fast to the downside. Now, there's two aspects to your reference to Michael Burry. One of which is he's saying that earnings are being artificially escalated on account of a practice that they are doing where they are actually lengthening the depreciation cycle on chips that are actually becoming second tier very, very quickly, thereby having an earnings effect. So accounting typically allows certain things to be depreciated at a certain rate. In terms of this technology, it should be depreciated rather fast, but they're extending that cycle. And that is one of the ways that they're managing to actually report higher earnings. Other things that are going on in the last NVIDIA earnings report is that they're channel stuffing. Channel stuffing is like what cars salespeople do. The Ford will provide an immense amount of stock to all its dealer network who will sit with full lots, but they'll record it as sales. And as an account receivable, that means they've not yet been paid because the dealers aren't making the money to pay them in advance for it, but that they are awaiting the actual end sale to take place. And then they would be paid for that sale that's actually transpired by that dealer. So you're actually forcing a pig in a python of supply, a glut, into your system. So they're doing that as well. The accounts receivable shot very, very high up. There's all sorts of other shenanigans. I mean, Meta, for example, has a SPAC, which SPACs have a terrible reputation. And you get a combination of SPACs, SPVs, which are special purpose vehicles, and special investment vehicles, SIVs. And these are all mechanisms for taking things off balance sheet. So they've created and got some investors involved with Blue Owl, who will be essentially the bag holder on these depreciating assets. So they end up holding it. The borrowing goes on to this special purpose vehicle, not on the Facebook balance sheet. So there's all sorts of what would normally considered to be fraudulent behavior, but that is just walking the line of legality, where they do just enough to say that technically it is an arm's length transaction. So there is all forms of smoke and mirrors in the financials, and Michael Burry is one of the few people that is spending time and effort exposing the extent of this to show that things aren't as grand in the AI space as they are. He's rarely wrong. He's often early, but rarely wrong. Some will say it's the same thing. I'd say there is a slight difference. So the fact that he folded his fund is probably because he put on the trade a tad soon, and they've continued to be able to squeeze up higher. But I expect he'll be accurate in the end in terms of this. And I expect there will be a bailout. Sachs is already positioning for that. We saw Sam Altman already positioning for that, and on X about 3 or 4 weeks ago. And this story isn't going away. So it's quite clear they know they're in trouble. The CDSs, which is the debt instrument to Oracle, are climbing ever strongly to the upside. That means a devaluation, the interest rates required for insurance against this. So everything is pointing to the fact that we are actually in an overextended malfeasance investment cycle into the AI space. And that is an opportunity, but it's also for general human man in the street, a future deval, contagion, demand destroying event, which is broadly bad. What do we do as speculators? We have a plan for that. And if you want me to drill down further, I will. But let me hand back to you first before I just ramble on.
Yeah, no, go ahead, because I was going to move on to some things we heard with oil. So I'll let you finish up on this.
So I'll give you an example of how people watching this program can get some real alpha and value from understanding what is broadly a bad situation for man in the street, because it's likely to lead to a bailout for deemed critical industry. And I would argue computing data centers by private companies never qualified for that, but they will make the mechanism to be such. So 2029, 1929, 2008, and 2021, we had massive corrections and even potential depressions, I would argue, brought about. And there are individuals, Barack from 1929, you had Paul Tudor Jones of 2000 dot-com era. So let me include 2000. And you had Michael Burry of 2008. These are avatar individuals that did 3 key things and then a fourth thing afterwards, that build their wealth extraordinarily when sitting in a grand, I would say again, a depression. They'll never use the word in real terms, but subprime was a depression. 29 was a depression. Dot-com was probably the beginning of depression economics, even though, again, it only qualified as a recession. What they did is they got liquid first. That means they divested from the stock market immensely. And you should be looking for indicators of this happened. Has it happened? Insider selling is huge at the moment on all equities. Most of the CEOs, most of the boards, most of the directors have been divesting from their own companies and selling out of their option strategies. And on X, I can show you countless, the top 100 sales, all red, of trades by insiders are all red. Net sales, no buying in, no divesting totally. Warren Buffett sitting on 380 billion plus in the money markets. Huge divestment from banks, from a lot of things. So stage number 1, the big names getting into cash and out of the hyperprice market, happening already. I would argue the same is also happening to Bitcoin, by the way. Go look at the OG wallets. Just a little side plot that I'm running here. And then 2, what's the next thing? Getting into capital preservational assets. Gold buying. Barack in 29, 2000, the dot-com, you had $253 gold. Getting into gold, getting out of the dot-com stock market, running into 99, 98, 99, early part of 2000. Getting into gold, preservation, capital preservation. That's step number 2 for wealth building in fiat debasement bubble loan lender times. And boy, are we the biggest of all and ever? And do we have the most synchronized global setup ever that has ever existed? So what went for 29, 2000 and 2008 goes absolutely double, quadruple to the 10x for today in terms of the market cap to GDP, by the way, which is at an all-time high, the Buffett indicator. The third step in how you profit from this is knowing the forthcoming volatility and building a profit center on collapse. So in our community, we have actively been talking and will be, I'm due another update with them today on the shorting of, and I will use put options with a long date to 2018, of all those things most hyped, most ridiculous by price to sales revenue, never mind earnings, that have gone well beyond that of Sun Microsystems in 2000. That was the ridiculous avatar of excessive valuation, such as Palantir, for example, MicroStrategy, Oracle, CoreWeave, Blue Owl, as I've mentioned with Meta, almost set up to fail. All of these will fall, put options on that will build a massive profit center in the event that I expect to happen, for which I suspect we're not too far away, of a contagion collapse in the AI, which has to happen and bring great pain in the economy to validate and justify the bailouts that I expect the government to want to bring, because they will take state ownership of the surveillance grid that the corporate fascists of Microsoft, Oracle, Meta, ChatGPT, NVIDIA have been building. They always like to go long on the upside. They want to be able to short it to the downside to build profits and then flush everybody out that was using margin and those that can't afford to meet their bills because they're going to create a liquidity shortage. Everyone's going to have to sell. They'll become forced sellers. They're going to pick it all up and own it all at the bottom, and possibly with the support of government money. They may even utilize that new print of government money. They may even utilize stable coins this time to issuance to start the proliferation of what they eventually intend to do, a CBDC, which stable coins are also bid in the treasury market. So all of this could transpire. You need to maximize the sell. What you then do, the fourth leg, which I said there's three key legs, and then there's number 4, is the profits from your puts that you would have made huge multiples on. Think of Michael Burry, the Big Short. Think of Paul Tudor Jones, what he did in the dot-com boom. All of those get converted back into either gold or miners, because miners may sell off more than gold because there will be equity sell-offs under forced liquidations through people that are being hard-pressed, cannot make a rent check, that are currently holding miners. So miners are a higher beta to gold because it's just harder to keep, pack up your 100-ounce silver bar, get it scanned, take it back, cash it in. People will sell their miners. There will be excess margins, because they were also longing NVIDIA. They'll be forced to close margins with losses. They'll be forced to close other positions. Their miners will be closed. The beta to the downside will be higher. You take your profits from the puts while there's blood in the street. Step number 4, you buy the hell out of the mining market at the worst possible time for the outlook for the economy. When all the mainstream newspapers have got headlines that are financial and about chronic pain. And at that point, that is the making of generational wealth. That's what I'm here to share with you. That's what our community is focused on doing, executing those 3 steps, and then final step plus 1, number 4, after and at the base of the key collapse. And that is a great model, and that's how we'll be able to support our community members and people to survive these events, and not only to survive, but to thrive in what is a creeping totalitarian world.
We talked about equities. I want to move over to one commodity since you were talking about puts here. Oil, expectation is we're looking at that coming down.
Well, we heard from, and I want to highlight a couple of things. We've continued to say this is a financial monetary problem that we are facing, and that the key trade is buying monetary metals. Now, monetary metals and oil all fall under the grand commodity universe. but they are extremely different. And our economic model has been that of hyperstagflation. And hyperstagflation is quite simply that there is a stagnation which is higher than usual, which is the other half of the balloon. That is retail man in the street. You ain't one of them. You aren't invited to the club. That is suffering immensely at the moment. And that is all of us, ordinary people, I would argue. And then at the same time, as all of that is happening, you also have the situation where you are getting the immense growth in that one captured area that is crowding out and causing stubbornly high inflation on things like cost of living and everything else. Part of the fiat and debt debasement that started in 2020 that we called on the key reversal. So the chart I'd like to bring up that will capture this really nicely. Let me just go to share screen and bring you up a couple of things that are fun. We called for this more than a year ago in September on a technical setup. So I just want to highlight this right here. This is, let's do it over here. This is got the gold versus oil trade. You will see this is our YouTube that we released in September saying this is your trade. Short oil, long gold. A market lesson you can't miss. YouTube, 6th of September, 2024. And when other analysts made comments about oil, and we've continued to say, be short the oil, long the gold. This gives you a commodity delta hedge. And in fact, both sides, at the time we did this, the oil price was $87. You are now $59 today. So this gives you a reduced volatility because you're doing commodity. If the dollar goes up, both might go down, but gold less so, oil significantly so. So you continue to make alpha on this. And this also rolls into the environment that we talk about, that this is a controlled demolition overall that you are experiencing, and it is a financial preservation of wealth epoch for which gold is the ultimate asset to own. Nothing else, not oil barrels, not oil stocks. And that because of the hyperstagflation, the stagnation, people are traveling less, they have less disposable income, they are buying less off Amazon, there's less deliveries, there's less plastic packaging, all of which is oil. And at the same time, the government doesn't want the CP lie, which is understating inflation, to run away, and is ensuring that there is huge supply of oil, including, I would say, the Russian energy markets, which is gas, oil, and everything else, which is being repurposed via India and still finding its way into the markets, with intermediaries making immense profits out of this phony sanctions war. The only people that are being killed is particularly Germany, that are experiencing more than double their energy prices, that have taken all their automakers to the brink of losses in terms of their manufacturing process, all due to politics surrounding the Russia-Ukraine conflict. So we are watching a controlled demolition of the Western world, particularly, as I mentioned, with regards to energy in Europe, where they're already paying extremely high prices on a very low dollar cost of oil. But because of don't forget, there was the international act of terrorism that blew up the underwater oil link that came into Germany. I'm trying to remember its name. Maybe you can prompt me and help me now. It's been a while. And the fact that you can't buy, that Germany is refusing to buy directly, and Ukraine are refusing to buy directly from Russia for obvious reasons due to the conflict. So we are watching essentially a controlled demolition of the Western world. With regards to energies, it's very specifically the worst affected is Europe. But inherently, the controlled demolition is also happening in the US with ridiculous expenditure, a parabola of debts, an absolute huge issuance of money, and unbalanceable books, trade deficits with Europe, which is part of the reason why America wants to be the only one selling them energy at very high prices to try level out that deficit. And also America with a ridiculous deficit to China, which was hitting records, which is part and parcel behind the tariff taxes, which are taxes on the American citizen on any aspect or component that is imported. So the whole game is not about good governments. It's all about the controlled demolition of the global economy. And here you can see this is gold. This is a weekly, my apologies, gold divided by oil. And this is when we called this breakout. In fact, when we started being on alerts far earlier than the September call. The September call over here was our latest point we're going now. We were warning this would happen. A left shoulder, a big head, and a right shoulder here, inverted head and shoulder. That target was made, a significant pullback, and now we are in continuation to the upside in the relative valuation of gold to oil. And you went from 14 down here, that means 1 ounce of gold bought you 14 barrels of oil, to now 71.76. I would say that was a pretty good trade call. Bearing in mind the neckline was at about 28 and you're at 71 today. You did trade 76, and I expect that high to be taken again, especially as gold had a pullback after hitting 4,304, 5, was it 4,400? And is now getting back on its bicycle to go. So this setup is very similar to the one we called for 2019. And that, you can see what went wrong there. There's that huge wick. But if for people that call the top on that trade and say, but we should all be buying oil stocks now, beware, beware. You will get in too soon. Here was the head and then the right shoulder again, with the head and shoulder here. That was the precursor to 2019. We were the only analyst. We went on number of stages and said single-digit oil. We'd never had that happen. The last time you were below $10 was in the 70s. And we called for single-digit oil and said gold long, oil short. During that period, gold ran to a high of 2021 from 2019 at over $2,000, and oil fell to zero in that. And we've made that same call again. So it feels very samey to us. And that is wrecking the consumer. They have to drop the oil price. So let me hand back to you after that narrative.
Yeah, I appreciate that, because I think what you pointed out was, the money in equities moves over into, let's say, things like commodities. And then even when you're in commodities, you have the different types, where it's oil, where it's gold. And then even within precious metals, you have where it's gold, where it's silver, where it's platinum. So I think you pointed out a very interesting space here, because you have to move around between, especially commodities, let's say, because they're all priced differently and they're all affected in different ways. Francis, I tell you what, let's continue on. Let's have a part 2 where we'll move into precious metals, and we'll leave this first part about AI. So if you don't mind, if you could tell the good people how they can follow you and get more of your insights, and we'll continue on with part 2.
So should you wish to follow us on the YouTube channel, The Market Sniper, we also cover crypto under The Crypto Sniper, and on X under The Market Sniper, regularly updating on how we will benefit out of the contagion that we fear is being brought into world markets and the AI bust that's likely to follow.
All right. Thanks, Francis. Let's move on to part 2. That was the Market Sniper, Francis Hunt, giving you the edge on the economy and precious metals. And if you want more precious metals insights and would like to know more about optimizing your precious metals portfolio, visit us at www.auctusmetals.com. Please do subscribe to our YouTube channel and give this video a thumbs up.